Tier one investors in the restaurant industry just have an endless appetite. What I tried to portray here, this was a compilation of information published by National Restaurant News literally this month. What they profiled is the largest operators of restaurant brands and food services brands. The single unit brands or single brand operators are those that are typically the franchisors or the corporate operator of a single brand. The folks with 2 to 5 are often an operator like that, or a franchisor with 1 or 2 brands, maybe like Ray at Hothead and Rapid Fire. But those folks that I highlighted in green, the private equity firms that operate more than a half a dozen brands, or aggregators who's aggregated even more than 20 brands under the same operating company, are making moves in this market. For the last 2 years, those firms collectively have generated more than 10% year-over-year growth in their businesses, and 75% of that is literally the result of them acquiring brands. I have friends that have come out of the firms like the Rourke's and other big, well-known PE firms, and from some lesser-known firms in the space, folks like Corlex Capital that really came out of Rourke. Those players are constantly searching for emerging brands that are at 10, 15, 20, 30, 50 stores. The two different tiers of operators are, there's some that seek the small operators that are ready to franchise or are already franchising, and then they try to ride them up to 200 stores and then sell that brand off to the big aggregators or private equity firms. The larger funds don't come in until you get over 200 units. But what I'm trying to present here is that 25 of the top companies in the world that operate food services businesses, largely restaurants, and a very high concentration in QSR or limited service restaurants and emerging into fast casual, are these folks that have between a half a dozen and 21 brands. They are making the market that we are building our restaurants for. This is a compilation from Aaron Allen Associates. They track mergers and acquisitions. They advise on it in the space. And what's interesting about it is that as the acquisitions have continued to happen year over year and the consolidations in the really large brands, the EBITDA valuations that they pay for a restaurant are going up and up and up. And whether it's a restaurant, a group of restaurants, or a franchisor, these deals typically are hundreds of restaurants in a transaction. But there are second-tier private equity firms that literally are out hunting constantly for bundles of 20, 30, 40 restaurants. They love the cash flows. They love the space. They're looking for established operators that may be independent franchisees. They may be corporate stores within a system. But you think about this, folks. When I go to the bank and borrow money to build a restaurant, a typical valuation is the cost of building the restaurant. And once that restaurant operates for 12 months, the valuation is 4 or 5 times EBITDA. These transactions are trading at more than 10 times EBITDA, which means if I build a bunch of fast casual restaurants, aggregate them together, operate them successfully, and ultimately in a couple of years deliver them to a private equity player who buys into the business or simply acquires stores or hires my management team to run those stores, I can literally double the value that I've created from the time the stores were built. And you'll see this other measurement, which is the 1.4x multiple of revenue. In a simplistic fashion, they're buying cash flows. They're buying based on a multiple of revenues as long as the EBITDA margins are there. And you'll notice on this slide, there's a modest amount of activity in the fast casual space on the top right, and literally some QSR brands still popular. But think about it this way, fast casual is the single smallest segment of the entire market, and yet it represents something on the order of 20% of all the acquisition activities that have happened. I'd like to jump into a couple of case studies that are examples of where we are. What I want you to think about is the rate at which these businesses open stores, how long it took them to get to critical mass, what value was created when the exit occurred, when the transaction that brought in private equity or an IPO type event occurred. And you'll notice where they are in terms of AUV. So Chipotle, everybody knows it sort of helped define the fast casual segment. I would argue that the line service style of Subway actually helped define the segment. But Chipotle, with its healthy menus and such, really crystallized that. Look at the kind of money that an investor like McDonald's made, where they got into that business when it was young. They exited a few years later at 500 stores, and literally, what is that, 4 or nearly 5x return on their money. That's why PE firms are in the space. That's why big franchisors occasionally pick up smaller brands. Today, that system, we don't have to read you the slides, but it's billions of dollars a year in sales. Despite its fall from grace a couple of years ago, it's come roaring back with the hiring of a CEO. Shows you how sensitive brands are to leadership. Literally, they're driving dollar per checkup through their limited time offers and their unique ways of repackaging their products in the Taco Bell-izing of Chipotle, as I like to say. And even they have rising food costs, but they set records. They were all over the news. Their quarterly reports put their stock as high as it has ever been, and their AUVs are starting to recover. I cite Chipotle because you can't franchise Chipotle. They're all corporate stores or JVs. This is our benchmark that we compete against. In markets where we're entering the market, Chipotle may have 15, 20, 25 stores. People know how to eat the product. I put the pictures in. It looks just like our product. Our product has more stuff, and we'll talk about why I believe we have a second mover advantage in a minute. But take note of the fact you've got a business that, like Subway, was opening over 100 stores a year. I think Subway even achieved 1,000 per year, but they're not that far away from the AUVs that we have. Qdoba, which I believe helped inspire Ray more than a decade ago, my brother who founded Hothead Burritos, when they created their business in the wake of what was Chipotle's kind of meteoric rise, it took them a lot of years to get to 50 locations. They went through multiple brand changes. But that first transaction was a $45 million transaction that was built for a fraction of that. And that, under while it became sort of a redheaded stepchild underneath Jack in the Box, which was really an LSR quick service business, the deal still spun out just recently for over $300 million. I use the example with Apollo Global Management because I know the Apollo teams from other capital markets work I do. Apollo is just the deal leader among many private equity firms that put that deal together. They bought what they believe was an undervalued business that had lots of growth. Look for them to come back with a vengeance in the market. But again, I'm using these two case studies because you can't franchise Chipotle, and Qdoba has licensed out most of the biggest, most popular markets. So the opportunity to get in the Qdoba system and control a greenfield market where you can put up 5, 10, 20 stores just doesn't exist. Note their AUVs at 1.13 million. I'll show you a chart of AUVs in a bit. They're lower than Chipotle. Chipotle defined the segment. They're right smack in the middle of where the players are clustered in pizza and Mexican. Let's transition to pizza for a minute. I'm going to show two examples. Mod Pizza came out of Seattle, the old Seattle coffee people. They raised a ton of capital. We found ourselves as a brand competing with them for locations where they were going out and signing leases, just tying up property. They announced recently that they are on their way to reach 1,000 locations in the next 5 years. They've been opening about 100 locations a year. The reason I'm citing that is we currently open about 1 location a month per brand. So 12 or 15 stores per year per brand. 100 locations a year is achievable with a mature area developer network. Today, we have about 15 area developers in our Mexican brand and our pizza brand, and they may get to 3 dozen stores a year or 4 dozen stores a year now that many of them have been settled in with for a time. What I'm trying to demonstrate here is 100 stores a year is not unreasonable. Our goal is to get to 200. We're at 112. These guys, it took them a long time to reach 30 locations, and now they're clocking off 100 a year. They've raised $350 million. Again, this event is about the amount of capital flowing into this market. They've funded 6 rounds. They didn't even make money for the first couple of years. They were simply tying up real estate, creating a brand, crossing people over from major brands, and much like we'll talk about Blaze in a minute, they were licensing out markets in high-profile license deals to operators so they could claim the turf. And now you got folks like CDR. CDR is not in here to make a little money with their money. CDR chases transactions. So this is big, big money coming into the space where we compete every day. I believe they're not a threat to us. We have a second mover advantage we'll talk about again in a minute versus Mod and Blaze in our pizza system. And notice their AUVs. Their AUVs at $9.98. They've slipped a little bit with store densities coming up, and they've also had some operational challenges. But again, I'm not knocking the brand. They have a good product. There's one 5 blocks from my house. I eat there occasionally because there's no rapid fire in my neighborhood. But the reality is that they are right in it neck and neck with us. And they have literally achieved 400 stores in a very modest amount of time, again, clicking off 100 a year. Blaze technically started a little later. Blaze, it took them, till 2015 to get to 50, 60 locations, 2014 to 50 locations. They're not opening quite as fast as the mod stores are, slightly different strategy, but they've covered more markets faster. They use a flag planting strategy. Well, that's great for them. It's not great for you if you didn't get in on it, because you can't necessarily go get Chicago or Fort Lauderdale or Dallas or LA, because very high profile operators crossed over to get there. Again, I'll talk in a minute about why I believe our second mover advantage puts us head to head against them. But the important thing to understand is they are doing 60 locations a year. We can do 60 locations a year by further expanding our area developer network. Their valuation at $250 million in 2017 literally took LeBron James with his famous stake equity position he took and made his $1 million worth $25 million. I'm citing that example because getting into these businesses when they're at small numbers of units and riding them up as they get brand penetration, national recognition, media power, it has a logarithmic effect on the value creation. And that's why you see multiple rounds. I think they've had 6 rounds altogether. Mod had 6 rounds. These guys have had multiple rounds, notable names in both restaurant-specific private equity and not restaurant-specific private equity. Again, they have clearly expressed that they are going for an IPO. They want to get there at 500 locations. Last published, we saw that they were at about 1.4 million in AUV. I haven't seen an FDD from them recently, so I don't know that that's changed. We understand there's been a little slide in that, but they're literally at about 300 stores. They covered 42 states really fast with their flag planting. We look forward to helping you. If you're interested in getting in touch with either brand or with us, you can certainly reply to the invitation. The invitation will cause you to get a link to a recording. If you enjoy the recording, you can certainly share that with your friends. You can also, again, go to our YouTube channel. Just search for Wiley Development Group on YouTube.